Okay, our agenda that we're going to go through today is we're going to go through selecting an auditor. We'll discuss some of the criteria that you can use in the selection process, what to look for in an audit, some of the required communications that auditors are required to give you, and you are required to get, your management is required to give auditors. And then we're going to go over questions, typical questions you can ask your auditor about the financial statements and the organization as a whole. Basic internal control measures. We'll discuss some of the internal control definitions and some of the procedures that can be implemented to mitigate the risk of fraud.
And actually, these materials are in your packets as well, both
The
guidelines
PowerPoint.
and the PowerPoint. So you can
Yep.
use that as a reference if you want to write on that too.
Okay, internal control selection, industry and evaluation criteria, industry experience, access to specialized technical resources, independence, reasonableness of scope and fee, ability to communicate useful recommendations, project management, quality control procedures, and the audit team chemistry are all items to look for in the selection process. We'll start with industry experience. The auditor should be able to provide you examples of other entities that they have audited, similar to providing references in a job interview. You should think of the selection process as an interview, and checking those references can be a very useful tool in determining which audit firm to go with. The auditor should have experience in the auditing industries that affect your entity, such as such as insurance and employee benefits, etc. The auditor should have experience auditing the various areas that affect your audit, such as investments, capital assets, pension plans, those sorts of things. Specialized resources. The audit firm should have the resources and/or employees with the experience in the special areas of your organization or your audit. They should be able to provide services related to IT, information technology. Be familiar with TIF districts and the reporting requirements of those if you have them. Be familiar with IMRF, police or fire pension plans, and the reporting requirements and disclosure requirements of those plans. Or be familiar with other types of insurance programs, such as the Illinois Risk Management League, that sort of thing. So, and be familiar with bond issues and other financing options that are available to governments, such as IEPA loans, etc., and the disclosure requirements of those. In addition, your auditor should be familiar with the latest GASB pronouncements. Government auditors are required to attend at least 80 hours of auditing CPE a year. Every 2 years, and 24 of those hours have to be in topics directly related to governmental auditing. So anybody who does a governmental audit should have those CPE requirements met. Independence is a key player in the auditing team. The audit engagement team, your local office, and possibly the organization as a whole should be independent from your organization. They should be able to to be able to give an objective opinion of your financial statements and not to be swayed by other factors. You should consider business relationships and employment relationships. If an engagement team member was formerly employed by your organization or associated with your organization as an officer, director, promoter, underwriter, voting trustee, or trustee of a pension or profit-sharing plan, they really should not perform your audit. Any money that is loaned to the audit engagement team member or to a business they're affiliated with. Participation in employee benefit plans of your organization. If they were a former employee of your organization, they should not be receiving benefit plans from your organization. Also, it's key to make sure that within your organization you alert everyone to the notion that if they do any discussions of future employment with your organization with audit team engagement members that could impair their independence and could result in you having to have procedures reperformed, additional cost, or having to have your audit redone by another organization that would be independent. So it's key to know that those kind of conversations can't go on while the audit is being conducted. And we have that in our engagement letters now, information about that to kind of alert the auditee that that's something that should not go on. So, and these rules also apply to the immediate family members of the engagement team, and possibly the firm as a whole. So that's important to know if any of their family members work for your organization or are affiliated in any way with your organization. Those are things to keep in mind. Accounting services or bookkeeping services that they perform for your organization. There's bookkeeping services that will impair independence and ones that won't. Things that impair independence are like authorize or approve transactions, change journal entries without obtaining the approval of management, preparing source documents or making changes to the source documents with approval, without approval. Things that do not impair independence would be to record transactions for which management has determined or approved the account classification. So if they're just compiling information from your trial balance, post client approved entries to the client's trial balance, and prepare reconciliation, bank accounts, etc., for management's approval. Those items would not impair the audit team's independence. Or proposing standard adjusting and correcting journal entries or other changes affecting the financial statements to management, provided that management reviews those entries and is satisfied that management understands the nature of the proposed entries. So a lot of times during your audit, the auditors will propose adjusting journal entries, and they can do that without impairing their independence, but they have to have management's approval to do those. That's why they give management a copy of those adjusting journal entries, and they agree or disagree with them. So there's that. Reasonableness of scope and fee is another criteria to use in determining who to engage. Controls scope of the audit. There are two different scopes. There's a controls approach. Would involve the testing of internal controls to determine if the auditor can rely on these controls to prevent material misstatement of the financial statements. If the controls are not reliable or non-existent, the auditor must perform substantive testing to determine if the financial statement numbers are free of material misstatement. So a lot of times they may assess your internal controls to see if they can rely on them, or if they must do substantive testing. Be sure that the audit firm discloses the hourly rates for the various levels of employees within the firm. That should be included in the proposal, and they should show you the rates by partners, managers, supervisors, and staff. Be conscious of unusually low, or be wary of unusually low bids, because this could result in a subpar audit due to not being able to bill the hours that are required to do the job. So sometimes that can be a problem. So ability to communicate useful recommendations. Evaluating communication skills of the auditor is important, how well they communicate. If there's frequent open communication available to you, that's important. Feedback for organizational improvements to be more effective and efficient, like the best practices for your organization, that's pretty key. Project management. Next. Yes, project management. Project management, the proposal should indicate the amount of planned interim versus final field work, how much involvement the manager or partner will have in the planning stages of the audit, whether the work is reviewed while the audit team is in the field, how the process is managed, communications to the board, status meeting, cost overruns. Those are issues to consider. Quality control procedures. There should be a second cold review done by a partner or manager that is not involved in the audit engagement. to look for just areas of concern that maybe the audit team didn't notice. A lot of times you're too close to the engagement, you may overlook something, and somebody who has an objective, cold review will pick up on items that you didn't consider or didn't notice. CPA firms are required to have another CPA firm do a peer review of their audit procedures and process at least every 3 years. They should be able to provide you a copy of their peer review, and you should make sure that they have passed that peer review process. They should have a passing grade. Inquire as to what procedures the firm has and to ensure quality audit, such as training of their staff and et cetera. Oops, sorry, went too far. Audit chemistry, professional and courteous, the appropriate dress, whether they conduct themselves in a professional manner, if they're friendly and approachable. Those are all key qualities in a good audit team, auditor. Professional skepticism involves not being too friendly with the organizational employees, that there is the appearance of impaired objectivity. Sometimes that can give, there may not be any impairment of their objectivity, but it can give that impression. They should have appropriate communication skills and be able to communicate with all levels of the organization, from your board to your manager to your employees, staff. They should be outgoing enough to be able to communicate what is needed to get the job done. Being able to effectively make suggestions to your organization, that's important for the audit team. So those are things to look for when selecting an auditor for your entity. Now we'll go over what to look for in an audit. Oh, I went the wrong way, sorry. Auditors should provide written reports on the financial statements. Will the firm draft your financials, or will the organization, or will that be the organization's responsibility? Most of the time, the audit firm drafts the financials. There still should be someone within your organization, management or otherwise, that can take responsibility for the accuracy of the content, and that person should have the suitable skill level to be able to review the drafted financial statements. The auditors are required to communicate to the board. Main ideas covered is the auditor's responsibility in relation to the financial statement audit, other information and documents contained in financial statements, the plan, scope, and timing of the audit. Number 1 and number 3 should be communicated to you at the beginning of the audit and are most times included in the engagement letter. Compliance with all ethical requirements regarding independence. There is a separate letter at the end of the audit that is provided to the board with these items in it. Significant accounting policies that were adopted in the current year or that will be applicable in future years. They usually include the ones that are coming up. Significant accounting estimates are listed there as well. Financial statement disclosures, if they've identified any or have any suspected fraud. Significant difficulties encountered during the audit, they have to tell you whether they've had any significant difficulties with management or any disagreements with management. They have to provide you with the uncorrected or corrected misstatements. They need to describe what accounting services they do for your firm, for your organization. Representation requested from management. They will request representation from management, and that's a separate letter that management gives to the auditors regarding the audit and what they're accepting responsibility for. Management consultation with other accountants. There's usually a blurb in there about that, and other significant matters, findings, or issues if there were any. The control deficiencies or management letter. It's different from the management representations letter mentioned earlier. Identifies any major internal control weaknesses or deficiencies with suggestion for improvement. Advice on other improvements that can be made, to improve operations that are related to the internal control issues, that are not related to internal control issues, sorry. Management's responsibilities to issues addressed in the letter with a time frame for completion. These items will be brought out in that letter and addressed, so they can give you some suggestions of improvements that you can make within your organization to help with internal control, or other areas that they see that might help improve your operations or your efficiency and effectiveness. A compliance audit, there are 3 listed there. The federal single audit, it's also referred to as OMB Circular A133 or an A133 audit for short. The Single Audit Act was originally passed in '84 to eliminate the need for multiple federal agencies that awarded funds to conduct audits of each recipient organization, many of which already had a financial audit done anyway. So this kind of cut down on the governments having to do that themselves. So they rolled it out to the audit firms who were already there engaged to do audits of these entities. It's a separate audit of the federal grant programs an organization expends and involves testing several areas of compliance with the grant agreements. It applies to all state, local governments, and nonprofit organizations and institutions. Currently, the threshold for the single audit to be required is $500,000 of federal funds expended, but the threshold is going to increase effective for audits that begin on or after January of 2015. The threshold will go to $750,000. So a lot of organizations will drop out of the single audit requirement when that threshold is increased. And it's January 1st, 2015. So any audits, any year ends that begin on or after that date will have the new threshold. So up until then, so right now it's still the 500, but when that date arrives, then it becomes 750. So, yeah, thought that was important to note. Tax increment financing districts is a separate report is usually required to be filed with the State of Illinois Comptroller's Office. The filing is done electronically by uploading the report directly on the Comptroller's website. It's due the same time as the annual financial report, and several items must be attached to that, such as letters from your CPA, attorney, chief executive officer, attesting to the compliance with the TIF Act. So, and then some of your grants will require special audit procedures, and those will be outlined in your grant agreements if there are procedures that are required other than the Single Audit Act and things of that nature. So it's good to know that some of them would have that. We'll go on to questions to ask your auditor. There are sample questions related to issued reports, annual financial reports. Were there any significant changes in financial statement amounts from the prior year? Your MD&A should cover significant changes that were made, and management usually will do the MD&A and prepare that. So any other services that the audit firm will be providing other than the audit should be detailed in the engagement letter or a separate engagement letter. And we have to remember the independence rules that we went over earlier as to whether they could do some other services for you or not, making sure that it doesn't impair their independence. Required communications with the board letter. Is there anything going on in the organization that you feel uncomfortable with or consider unusual or that warrants further investigation? Asking quantitative gut feeling type answers, that sort of thing. And further investigation usually is outside the scope of the original engagement, would require additional engagement from the audit team, and usually fees accordingly. We'll go on to the next one. The control deficiency letter, the board letter where we talked about, or the management letter where we talked about areas for improvement. The auditor should be able to explain the reasons for the changes they are recommending and how these changes could be implemented. They should be able to give you steps that you could go through to implement the changes that they're recommending. Some general questions. Are you aware of any anticipated event that could possibly impair the independence, in fact, or appearance of your firm or any of your staff? They should be able to answer whether their independence would be impaired. Being too friendly with the organizational personnel, again, like we say, can give the appearance of that professional skepticism of the auditor has been impaired. Were there any integrity or dishonesty concerns noted? The auditor usually assesses the integrity or honesty of management at the beginning and during the planning stages of the audit. And our professional standards require auditors to disengage from an organization if there is any concern over the lack of integrity or honesty. So usually by the time that you get to the board presentation, that should already have been taken care of. So, has management, legal counsel, or others made you aware of anything that could be considered a violation of laws, regulations, generally accepted accounting principles, professional practice, or other ethics? This is a good question to ask. If they have encountered any of these, they are required to tell you if they have encountered any of this. Are there any unresolved matters? Or are there any questions that we have not asked that we should? Those are some good questions to ask your audit team. Okay. So there's the questions. Let me adjust here. Now we'll go over some internal control measures. What is internal control? It's a systematic measures such as reviews, your checks and balances, methods and procedures instituted by your organization to conduct its business in an orderly and efficient manner, and to safeguard its assets and resources, to deter and detect errors, fraud, and theft, and to ensure accuracy and completeness of its accounting data, produce reliable and timely financial and management information, and ensure adherence to its policies and plans. That's a good definition of internal control. Some of the types of internal controls that you can do are those that affect the reliability of financial reporting, ensure the accuracy and completion of that accounting data. That's the key to those type of internal controls. Examples would include performing timely bank recs, segregation of duties, taking a periodic physical inventory of your assets. Those that affect the effectiveness and efficiency of operations include controlling the purchase order process so that supplies are not unnecessarily ordered, determining that time off abuses are not occurring, things of those nature. Compliance with laws and regulations. Examples of those type of controls would be ensuring that employees receive proper training, make sure that management is aware of the laws and that govern their organization. That's not my cell phone. I'm not sure whose it is, but it keeps beeping. There we go. Sorry about that. There are 5 interrelated internal control components: the control environment, or the tone at the top, risk assessment, control activities, information and communication and monitoring process. We'll go through some of these. The control environment sets the tone of the organization, influencing the control consciousness of its people. It is the foundation for all other components of internal control. Risk assessment is the entity's identification and analysis of relevant risks to achievement of its objectives, forming a basis for determining how the risks should be managed. Control activities are the policies and procedures that help ensure the management directives are carried out. Information and communication are the identification, capture, and exchange of information in a form and time frame that enable people to carry out their responsibilities. Monitoring is the process that assesses the quality of internal control performance over time. So we'll go through each one of these in a little bit more detail now. The tone at the top, factors affecting the control environment, integrity and ethical values. If the effectiveness of controls cannot rise above the integrity and ethical values of the people who create, administer, and monitor them. Integrity and ethical behavior are the products of the entity's ethical and behavioral standards. How they are communicated and how they are reinforced in practice goes hand in hand with those. A commitment to competence. Competence is the knowledge and skills necessary to accomplish tasks that define the individual's job. Board of Trustees, board and council participation. It's important that that the board stays involved in the internal control process. Attributes include the board and council member maintaining independence from management. That's important. The experience and stature of its members and the extent of its involvement in the scrutiny of activities, and the appropriateness of its actions, the degree to which difficult questions are raised and pursued with management. Management's philosophy and operating style also bear weight on internal control, and the tone at the top. Management's approach to taking and monitoring business risks, their attitudes and actions towards financial reporting, all can affect internal control, and their attitude toward information processing and accounting functions and personnel. Organizational structure. The entity's organizational structure provides the framework within which its activities for achieving entity-wide objectives are planned, executed, controlled, and monitored. The organizational structure should be appropriate for your size and nature of operations. Assignment of authority and responsibility includes how authority and responsibility for operating activities are assigned and how reporting, relationships, and authorization hierarchies are established. So, human resource policies and practices. Having a good human resource manual or employee manual will help with identifying how they should go about their duties and implementing internal control practices. It's a good framework for how they should conduct themselves. So that's the control environment there. Risk assessment. Risk can arise due to the following. You should identify risks for potential errors and fraud within your organization on a periodic basis. Identifying those risks will be helpful in managing them and implementing procedures that can help to mitigate those risks. Changes in operating environment. Changes in the regulatory or operating environment can result in changes in competitive pressures and significantly different risks. New personnel may have a different opinion on internal control or may be able to give you some insight into other internal controls you might not have thought of or things they may have done in another organization. So that may change the risk assessment. New or revamped information systems. Sometimes if you change your information system, it can cause the potential for risks to arise in your organization. If your organization is expanding at a rapid rate, it may be difficult for you to maintain a good segregation of duties and things of that nature for your internal control. New lines or products or activities. If you're entering into an area that you're not familiar with, sometimes that can cause some problems with internal control. Or if there are restructurings, that sometimes can give rise to risks for internal control. And new accounting pronouncements, adopting the new accounting principles, can cause issues to arise for risks, and you may need to reassess your internal controls. Internal control measures, control activities. Controls that may be characterized as policies and procedures that pertain to the following. Performance reviews, reviewing your employees' performance on a regular basis will be helpful with internal control, or even just evaluating your organization's performance in relation to your budget or your forecasts or your prior period performance will help to identify areas that are of concern. Information processing, making sure that your information is accurate, complete, that transactions are properly authorized. They have general controls and application controls. General controls are over data center operations, such as passwords for your protecting your computer, access to your computer programs, or access to the financial data, requiring passwords and securing those passwords. Having them changed periodically will also help in providing control over the information processing area. Physical controls, locking up cash, source documents, ensuring that source documents can't be tampered with, making sure that there are no missing numbers in your source documents, that your POs are numbered, and that you're not missing any, and if they are, they've been voided. Ensuring that items are stamped as canceled. That's a good internal control for the physical control. Taking inventory counts of your assets, like we talked about earlier, will help detecting if fraud has occurred or if theft has occurred. Those are good in physical controls. Segregation of duties. Again, one person should not have access to, they should not be able to perpetuate and conceal errors. Being able to do the entire process from beginning to finish can increase the potential for somebody to be able to steal or perpetrate a fraud. So having control over the entire process is one of the things that affects internal control. The type of control activities, preventative controls are like your segregation of duties, your appropriate lines of responsibility and authority and proper communication, your signed statements, your written contracts and agreements. Those items, those prevent the occurrence of a fraud or a theft. Your detective controls are they're compensating controls when your preventative controls are not in place. They involve recalculations like reperforming the bank recs, or checking the control totals, or analysis and review, independent reconciliations, like I said, follow up on observations, rotation of staff, like requiring your employees to take vacation and somebody else to do their duties, like what happened in Dixon, she went on vacation. Doing things like that can help to mitigate that or detect if a theft or a fraud has occurred. Information and communication. Information systems relevant to financial reporting objectives, which includes the accounting system, consists of methods and records established to record, process, summarize, and report entity transactions, maintain accountability for your assets, your liabilities, and your equity. They encompass methods to determine that, or methods and records that identify and record all transactions, describe on a timely basis the transactions in sufficient detail to permit proper classification of those transactions for financial reporting, measure the value of the transactions in a manner that permits recording their proper monetary value in the financial statements, and determine the time period in which transactions occur to permit recording of transactions in the proper accounting period. That is also important. Present properly the transactions and related disclosures in the financial statements. Communication involves providing an understanding of individual roles and responsibilities pertaining to the internal control over financial reporting. Open communication channels help ensure that exceptions are reported and acted on. And communication can take the form of policy manuals like we talked before, accounting and financial reporting manuals, memoranda, and it can be oral or through the actions of management, that sort of thing. Monitoring is a process that assesses the quality of internal control performance over time. It involves assessing the design and operation of controls on a timely basis and taking necessary corrective actions. This process is accomplished through ongoing monitoring activities, separate evaluations, and or a combination of the two. Sometimes your monitoring activities may come in the form of complaints from customers if they are billed, again, for the same service that they already paid for. That could be a monitoring activity to identify something that is going on in your organization, or if employees complain. That may also show up in internal control issues, so, and show the functioning of your internal control, and from external regulatory agencies or from the auditors. So those are some of the monitoring activities that goes on in internal control. I'm way ahead of time. I talk fast when I get nervous, so I'm way ahead of time. We don't have much left to go. Y'all get out of here early. You'll be happy, right? Okay. Fraud prevention and detection. I want to read you some definitions of fraud. From Black's Law Dictionary, it is a general term that embraces all means by which humans can devise, which is resorted to by one individual to get advantage over another by false suggestions or by suppression of truth, and includes all surprise, trickery, cunning, dissembling, and any unfair way by which another is cheated. That's the Black Law Dictionary of fraud, definition of fraud. U.S. Supreme Court says a tort or a legal wrong that means the following conditions: misrepresentation of material fact, the perpetrator knew it was false, made with the intention that the representation would be relied on, and the victim did rely on it and resulted in a loss or suffered a loss. The ASCPA Society defines it as a broad legal concept that is distinguished from error depending on whether the action is intentional or unintentional. So fraud may look like fraud, but it might just be a mistake. It's easy to make mistakes. Everybody does. Some of your types of fraud are misrepresentation in the financial reports, false or overstated expense reimbursements, false or overstated vendor invoices, check tampering, lapping of cash receipts, bogus credits, a fictitious vendor, substitution, altering bank deposits, forging checks, kickbacks, bid rigging, ghost employees, skimming, overstatement of payroll hours or effort, asset misappropriation, stealing, theft, or larceny. So overstatement of payroll hours or effort, like in the case that you were talking about of the employees that were goofing off, that could be considered overstatement of effort. Or in the case of the person who was filling up their tank, there was a good internal control over the credit card, they wouldn't be able to do that. So things of that nature, that they had to have receipts that proved that expense was for the entity that would help mitigate that or correct that or prevent that from happening. If they knew they were going to have to give a receipt for that, they would help with that. Ghost employees are employees that don't really exist that are still receiving a paycheck. Or vendors that don't really exist that are getting payments. Some if the manager or the director has the ability to create a fictitious employee and send the paychecks to their address, then it would be tough to catch that, to know that that person really wasn't an employee. Some of your smaller organizations, you would know that, but some of the larger organizations, maybe not. So looking at those vendors, looking at those employees carefully, it's good to do that when you're examining requests for payment of items. So independent, let's see, where are we at here? Fraud prevention examples. Some examples of fraud prevention are the segregation of duties, the rotation of duties and positions that are susceptible to fraud, requiring the employees handling financial transactions to take your regular 2 weeks vacation, adherence to organizational policies and procedures, especially those concerning documentation and authorization of transactions, physical security over the assets, proper training of your employees, independent reviews and monitoring tasks, clear lines of authority, conflict of interest policies, which are enforced, and regular independent audits of areas more susceptible to fraud. Some of your fraud detection accomplished by independent reconciliations, inspections of documents like your canceled checks, employee complaints, discovery of unusual items that indicate follow-up is necessary, problems detected during audits, customer or vendor complaints such as payments not being credited, things of that nature.